Think making more money makes you rich? Think again. Welcome to Finances with Finn, where we expose money mistakes before.
We usually view the economy as a simple exchange. You trade your time and physical effort for a proportional amount of money. In a purely physical system, the math remains straightforward. Acquiring an item of high value requires you to first produce and save an equal amount of value through your own labor. But life often moves faster than your paycheck. You look at the modest savings from a month of work, compare it to the high price of the asset you want today, and face a massive mathematical deficit. Under the normal laws of physics, bridging that gap requires years of patience and repetitive labor. Because we are naturally impatient, we instinctively look for a systemic shortcut to bypass the years of waiting. To find that shortcut, most people take the path society has already paved. They walk into a commercial bank to request a loan. We go in believing the bank acts as a simple middleman. We imagine they are handing us a slice of hard-earned cash that other savers have safely stored away in a heavy steel vault. In reality, the banker bypasses the vault entirely. They ignore physical deposits and paper currency throughout the entire process. Signing that paperwork moves you out of the physical rulebook of labor. You enter a frictionless digital system where entirely different laws of financial physics apply. A loan approval functions as a moment of digital creation, where funding appears instantly through a few taps on a computer keyboard. In fractional reserve banking, your deposited physical dollar becomes a regulatory anchor. The bank uses that single dollar to mathematically multiply its lending power, legally issuing 10 times that amount in new digital loans. These digital dollars did not exist 5 seconds before. Commercial banks create money rather than moving it, typing brand new digital currency into the global supply out of thin air. This creates a brutal asymmetry. The banker spends 3 seconds hitting a keystroke to create loans, while you must spend hundreds of hours of your irreplaceable life working to pay it back. Repayment requires the return of the original principal plus compound interest, which acts as a continuous, uninvited drain on your monthly productivity. The common response to this burden is brute force, taking on a second job or grinding out overtime to outpace debt with raw physical exhaustion. However, the system is designed to penalize physical labor. As banks print new credit, they expand the money supply and trigger inflation, which dilutes the purchasing power of every new dollar you earn. Tax withholding further complicates the struggle, slicing away a massive percentage of your extra labor before you can even apply it to the debt. Trying to outwork a depreciating currency guarantees a mathematical loss. You cannot win a game where the referee prints the points for free. This cycle is the monetary trap. It relies on the fact that currency is a depreciating illusion, continuously engineered downward by the expansion of debt. The danger lies in the contract. You agree to backstop the bank's weightless digital numbers by risking your very real physical property as collateral. You can play this mechanism in reverse. Instead of hoarding paper cash that loses value, the strategy is to acquire assets that inflate alongside the expanding money supply. When banks print new credit, the prices of productive hard assets, like broad index funds, businesses, and real estate, rise naturally. Owning these assets flips the mathematics. When the money supply expands, your wealth compounds on autopilot, completely detached from your physical labor. You may feel trapped by existing debt or a lack of capital, but the law of compound interest works relentlessly on any amount you start with. The first step is a hard stop on depreciating liabilities. We've seen how the shortcut of high-cost consumer items leads to debt. Every dollar spent on a liability is a dollar that cannot be used to fight the inflation treadmill. Second, you must permanently plug the drain on your income. Aggressively target and pay down high-interest debt to stop the interest leaks. Third, automate your escape. Set up a system that converts your remaining cash into wealth-building index funds the moment your paycheck arrives. Redirecting your money away from bank-owned debt and into self-owned assets is the only proven method to break the trap. It is how you finally stop trading your limited human time for digital illusions.